Neelkanth Mishra is with us. He's Chief Economist at Axis Bank. Neelkanth, great to have you with us here. Thank you very much for your time. Neelkanth, of course, also heads the global research at Axis Capital. Neelkanth, how is, your first take in terms of implications for markets from what we've heard? So two things. One, let's assume that what we heard from the finance minister in the budget is largely what stays when we get the full budget in July as well, right? Because if it's vastly different, then there's not very much you can take off from this one. First, so will we see that? Will we see continuity like what we saw in 2019? 2019, there wasn't very much change between what was announced in vote on account and what was announced in July. So is that going to be this time around as well? And second, Neelkanth, there is some concern at the margin that maybe government spending is starting to peak out a little bit. You take a look at sort of capex spending, which has been projected to grow at about 11%. It's much lower than what we've seen over the last 3 years. Go on.
No, thank you. Thank you for inviting me on the show. On the first one, yes, I think the interim budget and the final budget shouldn't be very different. Remember that the government is a very large organization. There are many ministries. Those ministries are given budgets. Those budgets then there has to be a sense of planning. One of the reasons why, if you remember, the budget day was shifted from 1st March to 1st February, or late February to early February, was that there should be more time for planning. Now, if you announce a budget in July and you get it approved by, say, late July, early August, there is not too much time left for the ministries to start spending. So I think from a spending plan perspective, one should not expect much of a change. There can be, I think, changes in the speech. For example, announcement of new schemes, if some, taxes have to be changed, if, say, the DTC implementation have to happen, all are hypothetical, but those kind of announcements can happen. But from a fiscal numbers perspective, the broad contours should remain the same. In fact, they should remain quite predictable going forward. On the second question, on whether the government expenditure is peaking out, I think that's a deliberate choice. So if you heard the comments from the finance minister, the call was very clear that we think that the private sector is now starting to spend again, and therefore the government should dial back its spending. And that, in a way, was the most remarkable takeaway from the budget, that the government very likely had the fiscal space to spend more, in the sense that the fiscal deficit target was, the range of projections from economists was 5.2 to 5.5%. And the government chose to go with 5.1%. And that shows that the government is confident that the private sector is starting to feel confident enough. Households are starting to feel confident enough in aggregate. And therefore is willingly dialing back. In democratically elected governments, this is the hard part, right? So economic theory says that government should spend when others are scared, and they should dial back when the others start feeling confident. The second part generally is very difficult for governments. It's quite commendable that the government has chosen to go down that path.
Wow, this is a fabulous rally that we have on our hands. Don't lose sight of that. It's ticking higher as we speak. The Nifty is now just about 100 points away from that 22,000 mark and that lifetime high. I mean, we're barely, 0.5% away from those all-time highs. The Sensex is up 800 points. This is a huge post-budget rally that we have on our hands. Neelkanth, hi, good morning. So since we're talking about, analyzing threadbare the budget, the other thing that the street liked was that the tax receipts this time around, the expectation is that it could exceed the budgeted growth. The budgeted growth is around 12.5%. But there is one camp that believes that gross taxes could be higher because of corporate income and the point that you made about corporate spending picking up. Your thoughts on that? Do you think that could in any way have a positive implication overall?
Yes, so there are two elements of that. The first is what are the assumptions for the fourth quarter this year, so FY24 RE. And I somehow think that the government assumptions in the fourth quarter on the tax side or the direct tax side are actually too conservative. And once you adjust for that, the year-on-year growth in FY25 that is implied also will be a bit on the lower side. So I think it'll be easier to achieve those numbers. If you see the last, say, 30, 40-year pattern, the personal income tax to GDP has been rising steadily. The pace of increase has accelerated in the last 4 years. So between 2001 and 2019, the personal income tax to GDP went up by about 5 basis points a year. What we have seen since 2019, it is rising at about 20 basis points per year. I think the increase that the government has budgeted is quite a bit lower than that. So I think that those numbers seem achievable. On corporate tax, we had gone from 1.5% of GDP in 2003 or so to about 4% of GDP in 2008. That, if you remember, was the time when the government was generating primary surpluses. As the profitability, as the profit share of GDP started to come off, corporate income tax also came off as a percentage of GDP. It had dropped out to 2.3%. It is now starting to rebound. This was very much aligned to, if you remember, nearly all of last decade, Nifty EPS growth was only about 4% or so. Now that Nifty EPS growth is in double digits, mid-teens, it is reasonable to expect that this number also will improve going forward. So I think the FY25 on 24's base, the numbers are reasonable. They're not too conservative. But once you adjust for the fact that FY24 itself could be higher than what the government has in the revised estimates, I think those numbers look very credible.
All right. Hi, Neelkanth. Good morning. Nigel on this side. Neelkanth, what about the divestment target? You know, the roaring stock market with the kind of sentiment turn that you have had to some of these PSUs, would you have expected them to be a little bit more aggressive on that front? Because timing seems to be perfect.
You're right. I think the opportunities to execute on what the government has flagged, and I think does believe that the role of the government in business and the economy should be a lot smaller. I think that intent is still clearly there. I think part of the reason why the government has become a lot more conservative in its budget estimates for this investment is the successive disappointments. So you have the intent, you want to execute on something, but somehow the machinery is not able to execute on that. So I do think, in fact, if you look at the value of government holdings in the BSE 500, in just 2 years, in March 23, it was 12 trillion rupees. In December 23, March 21, it was 12 trillion rupees. In December 23, it was 35 trillion rupees. It has nearly tripled. And that's a great opportunity, I think, especially as the demand for equities from retail investors through mutual funds and directly is very strong. And increasing the supply for that. So as we are seeing the surge in QIPs and IPOs, I think it's a very good opportunity for the government to take advantage of that and also, prudently bring down the debt to GDP and the fiscal deficit targets. There is a reason why they're not budgeted for that because they've been disappointed by what the machinery has been able to achieve. But I'm sure there is an opportunity and it can be executed on in the coming fiscal year as well.
Neelkanth, actually, so much happening. It's such a vibrant market. So we'll identify some of these names in a bit. But the market itself, Neelkanth, you've always believed that it's more the global macros and global market macros which will affect things here. It's quite incredible. Here in India, at least we had a small pullback, right? Short-lived, however short-lived, smaller pullback. In the US, 3 months now, nothing, just up and up. And of course, in India, we've got elections now. I thought we'll probably have some consolidation and then have a pre-election rally. Because surely elections are 3 months away. You can't rally for 3 months into the elections, right? What's your sense? I mean, what are you telling clients?
No, our view remains that, look, part of the reason that the US markets seem to have rallied is that, the hopes around the soft landing, the fact that the Fed will start easing interest rates. And despite the Fed now signaling that March may or may not be on the cards for the rate cut, the fact that 10-year yields have now fallen to 3.76 is a sign. I mean, I think this is mostly because of growth concerns coming in. And I think some of the signs that I see in, say, the small banks in the US, the balance sheets of some of these banks seem to be clearly a sign of concern. In the second half this year, I think some of the refinancing challenges for commercial real estate in the US, which we have discussed for a long time, but at least the rollovers haven't started in a big way yet. All of those risks, I think, are still ahead of us. And whether the rally will persist into the elections, given that, I think that elections, there is now a lot less of uncertainty. I'm not sure that that becomes a very major milestone for the market, because as the uncertainty on that is reduced, perhaps a lot of the action that was supposed to happen has been priced in. So I still believe that, from a market and economy perspective, elections in the near term actually shouldn't have that much of an impact.
Okay, elections shouldn't have that much of an impact. Got it. Thanks, Neelkant, for joining in. Really appreciate your thoughts here.